Imagine it's February 2026. You're a mid-level analyst at the U.S. Treasury Department's Office of Debt Management, sitting in a windowless conference room 3 floors below street level in Washington, D.C. Your job, the one nobody outside this building thinks about, is to figure out how the United States government borrows money, not whether it borrows. That question was settled decades ago. Your job is the how. How much this week? At what maturity? At what rate? And this morning, you're staring at a spreadsheet that should terrify anyone who understands what it means. In the next 14 months, approximately $9.2 trillion in U.S. Treasury securities will mature. That money has to be paid back. Not theoretically, not eventually. The bonds come due, the holders expect their principal, and the government must either pay them from tax revenue it doesn't have or do what it always does. Issue new bonds to pay off the old ones. Roll it over. Except, here's the problem. Those maturing bonds were issued between 2020 and 2022, when interest rates were between 0 and 1%. The new bonds replacing them carry rates between 4.5 and 5.5%. You are refinancing the most indebted government in human history at rates roughly 4 to 5 times higher than what it was paying before. And nobody outside this room seems to understand what that means. This isn't speculation. It isn't theory. The bonds have already been issued. The maturity dates are already printed. The interest rates are already higher. This is not a story about what could go wrong. It's an autopsy of a system that already broke. It just hasn't made the sound yet. Most people, when they think about government debt, think about a large number, $36 trillion. They hear it, they acknowledge it's big, and they move on. The number has been large for so long that it has lost all meaning. It's become background noise, something politicians mention in campaign speeches and then immediately ignore. And that's precisely the problem. Because the danger was never the size of the debt. The danger was always the cost of servicing it. And in 2025, that cost crossed a line from which there is no easy return. Let me explain what actually happened. Between 2008 and 2021, the United States government operated under what historians will likely call the most favorable borrowing conditions in the history of sovereign finance. After the 2008 financial crisis, the Federal Reserve dropped interest rates to near zero. They stayed there with brief interruptions for the better part of 13 years. During that window, the U.S. Treasury did what any rational borrower would do in a low-rate environment. It borrowed, massively. The national debt roughly tripled, from about $10 trillion in 2008 to over $31 trillion by late 2022. But here's the part most people miss. Because rates were so low, the annual interest cost on that growing mountain of debt stayed relatively flat. In 2015, the government paid roughly $223 billion in net interest on about $18 trillion in debt. By 2021, it was paying approximately $352 billion on nearly $29 trillion. The debt had grown by 60%, but the interest bill had grown by only about 58%. The math worked, barely, because the average interest rate on outstanding Treasury securities had fallen from about 2.4% to roughly 1.6%. Cheap money masked the structural problem, and the debt was metastasizing, but the symptoms were suppressed. Then the Federal Reserve did what it had to do. In March 2022, inflation hit 8.5%, the highest in 4 decades. The Fed began raising rates at the fastest pace since the early 1980s under Paul Volcker. By mid-2023, the federal funds rate sat between 5.25% and 5.5%. And this is where the maturity wall enters the story. U.S. Treasury debt isn't a single loan. It's a constantly rotating portfolio of securities with different maturities. Some are 30-year bonds, some are 10-year notes, some are 2-year notes. And a significant portion, more than most people realize, are Treasury bills, which mature in 1 year or less. During the low-rate years, the Treasury increasingly relied on shorter duration debt. It was cheaper. The rates on short-term bills were essentially zero. Why lock in a 30-year bond at 2% when you could borrow for 3 months at 0.1%? It made sense at the time. It always makes sense at the time. But the consequence of that strategy is that a massive portion of the federal debt has to be refinanced every single year. And when rates go from near zero to over 5%, every single one of those rollovers becomes dramatically more expensive. This is not a crisis that arrives with a headline. It arrives with a spreadsheet. Quarter by quarter, auction by auction, the average interest rate on outstanding federal debt creeps upward. Not because anyone made a mistake, not because of a policy error, because of arithmetic. Old cheap debt matures. It gets replaced by new expensive debt. The blended rate rises, the interest bill grows, and it compounds. Think about what that means. In fiscal year 2023, net interest on the federal debt was approximately $659 billion. In fiscal year 2024, it crossed $880 billion. The Congressional Budget Office projects it will exceed $1 trillion annually by 2026. Some estimates suggest it may reach that figure ahead of schedule. To put that in proportion, $1 trillion in annual interest payments would exceed the entire defense budget. It would exceed Medicare spending. It would be, by itself, larger than the total federal budget of the United States in 1987. And it buys nothing. No roads, no schools, no defense systems, no healthcare. It is the cost of having already spent money you didn't have. It is the bill for the past, due in the present, paid at the expense of the future. Now let me show you the mechanism that makes this irreversible. There's a concept in sovereign finance that doesn't get discussed enough in public discourse. It's called the interest expense to revenue ratio. It measures what percentage of the government's incoming tax revenue goes directly to paying interest on existing debt. In the early 2000s, this ratio was around 8 to 9%, manageable. By 2024, it had climbed toward 20%. That means roughly 1 in every $5 the federal government collected in taxes went straight to bondholders, not to services, not to infrastructure, not to citizens, to creditors. And this ratio is rising structurally because of the refinancing dynamic I just described. It will continue rising as long as new debt is issued at rates higher than the debt it replaces. There is no mechanism within the current system to stop it without either dramatically cutting spending, dramatically raising taxes, or fundamentally changing the relationship between the Federal Reserve and the Treasury. Here's why that matters. When your interest costs consume a small share of your revenue, you have fiscal flexibility. You can respond to recessions, you can fund emergencies, you can invest in the future. But as that ratio climbs, your flexibility shrinks. You begin to borrow, not to invest, but to pay interest on previous borrowing. This is the debt spiral, and it has a very specific historical signature. Let me take you to Greece, 2010. In the years leading up to the European sovereign debt crisis, Greece's debt to GDP ratio climbed from about 100% to approximately 127%. Those numbers, incidentally, are lower than where the United States sits today. But the trigger wasn't the debt level itself. The trigger was the refinancing cost. When bond markets lost confidence in Greece's ability to manage its obligations, the interest rate demanded on new Greek government bonds spiked. 10-year yields went from around 4% to over 35% in a matter of months. Greece couldn't refinance. It couldn't roll over. The maturity wall became a maturity cliff. The country was forced into a bailout by the European Central Bank and the International Monetary Fund, with conditions that imposed devastating austerity on ordinary Greek citizens. Pensions were cut, public sector wages were slashed, youth unemployment hit 60%. The Greek economy contracted by 26% over 5 years. Not because Greece spent too much in any single year, because it had borrowed cheaply for too long. And when the cost of refinancing changed, the math became impossible. Now, I'm not saying the United States is Greece. The differences are real, and they are important. The United States issues debt in its own currency. It has the Federal Reserve as a lender of last resort. The dollar is the world's primary reserve currency. These are structural advantages that Greece never had. But those advantages don't eliminate the constraint. They change the form in which the constraint expresses itself. Greece couldn't refinance and was forced into external austerity. The United States, if it reaches a similar mathematical wall, has a different set of options. At this point, there are only 4. None of them are painless. That's the trap. Option 1, cut spending dramatically to close the deficit. This would mean reducing Social Security, Medicare, Medicaid, defense, or some combination of all 4. These 4 categories, plus interest payments, now constitute roughly 85% of federal spending. Everything else, education, transportation, science, foreign aid, environmental protection, fits in the remaining 15%. AU could eliminate all discretionary spending entirely and still not close the deficit. The cuts required would be politically unthinkable. No Congress in modern history has attempted them. No electorate would accept them voluntarily. This option is technically possible and practically impossible. Option 2, raise taxes dramatically. The federal government currently collects revenue equivalent to roughly 16 to 17% of GDP. Closing the projected deficit would require raising that figure to approximately 22 to 24%, levels the United States has never sustained in peacetime. This would require not just higher rates on the wealthy, but significant increases on the middle class, the group with the broadest tax base. Technically possible. Politically, it has no constituency. Option 3, financial repression. This is the option. History suggests is most likely because it's the one that doesn't require a vote. Financial repression is a set of policies that allow governments to erode the real value of their debt without explicitly defaulting. The most common mechanism is allowing inflation to run above interest rates for a sustained period. If inflation is 5% and your debt pays 3%, the real value of that debt shrinks by 2% per year. The government's burden lightens. But the cost is borne by savers, by retirees on fixed incomes, by anyone holding cash or government bonds. It is a tax that is never voted on, never debated, and never called a tax. The United States has done this before. Between 1945 and 1980, the debt to GDP ratio fell from approximately 119% to about 32%, not primarily through spending cuts or explosive growth, but through a sustained period of moderate inflation combined with interest rate suppression. The Federal Reserve, under informal pressure from the Treasury Department, kept rates below the rate of inflation for decades. Bondholders were quietly repaid in depreciated dollars. It worked. But the people who paid for it were ordinary savers and workers whose purchasing power was systematically eroded over a generation. Option 4, monetization. The Federal Reserve directly or indirectly purchases government debt, effectively creating money to fund the deficit. This is the most inflationary option and the most dangerous to the dollar's reserve currency status. It has been done before, in different forms, in different countries, and it has never ended well when done at scale. Weimar Germany in 1923, Zimbabwe in 2008, Venezuela after 2015, Argentina repeatedly. The pattern is the same. The mechanism is the same. The government cannot fund itself through taxation or market rate borrowing, so it funds itself through the central bank. The currency absorbs the cost. The citizens pay. Now here's the critical point that almost no one in public life is willing to state clearly. These are not future options to be weighed and debated. The United States is already executing a combination of options 3 and 4, quietly, incrementally, without acknowledgement. The Federal Reserve's balance sheet, which stood at roughly $900 billion before 2008, peaked at nearly $9 trillion in 2022. Quantitative easing, the program through which the Fed purchased trillions in Treasury securities and mortgage-backed securities, was, in functional terms, a form of debt monetization conducted through the banking system rather than through direct money printing. The distinction is real in academic papers. In its effect on the money supply and the government's borrowing costs, the distinction is considerably less clear. And this is where 2026 becomes pivotal. The maturity wall hitting in 2025 and 2026 is not arriving in isolation. It is colliding with several other structural pressures that amplify the problem in ways that no single one of them would achieve alone. First, the Social Security Trust Fund. The Old Age and Survivors Insurance Trust Fund is projected to be depleted by approximately 2033, with some estimates moving that date forward. Upon depletion, benefits would be automatically cut by roughly 20 to 25% under current law, unless Congress acts. But any congressional action, whether benefit reductions, payroll tax increases, or general fund transfers, adds fiscal pressure at precisely the moment the refinancing wall demands it decrease. Second, corporate debt. It isn't just the federal government facing a maturity wall. American corporations issued enormous quantities of debt during the low-rate era. Approximately $1.9 trillion in corporate bonds come due between 2025 and 2027. Many of these companies locked in rates between 2 and 4%. They will refinance at 6, 7, or 8%. For companies operating on thin margins, this increase in debt service costs translates directly into layoffs, reduced capital expenditure, or default. His corporate refinancing wall occurs simultaneously with the sovereign one. They are not separate problems. They are the same problem expressed at different levels of the economy. Third, commercial real estate. The post-pandemic shift to remote and hybrid work has left office vacancy rates at historic highs across most major American cities. Approximately $1.5 trillion in commercial real estate loans mature between 2025 and 2028. Many of these properties are now worth significantly less than the debt they carry. Regional banks, which hold a disproportionate share of commercial real estate loans, face potential losses that could trigger localized banking stress. This is not theoretical. In 2023, Silicon Valley Bank, Signature Bank, and First Republic Bank failed in part due to asset liability mismatches created by the rapid rate increases. The commercial real estate problem is larger, slower moving, and hasn't peaked yet. Fourth, the erosion of dollar hegemony. The dollar's reserve currency status, the very thing that grants the United States its extraordinary borrowing privilege, is under gradual but measurable pressure. In 2001, the dollar comprised about 73% of global central bank reserves. By 2023, the figure had fallen to approximately 58%. The decline is incremental. It is not a collapse, but it represents a slow erosion of the structural advantage that allows the United States to borrow at rates lower than its fiscal fundamentals would otherwise justify. If that advantage weakens further, every Treasury auction becomes marginally more expensive. And at $9 trillion in rollovers, marginal differences become enormous. This is where it breaks. A problem has a solution. A trap is a situation where every available response creates a new problem of equal or greater magnitude. If the Federal Reserve cuts rates to ease the refinancing burden, it risks reigniting inflation, which is itself a form of hidden taxation on every citizen who holds dollars. If it keeps rates high, the interest burden accelerates, the deficit widens, and the debt grows faster. If Congress cuts spending, it triggers economic contraction and political upheaval. If it raises taxes, it slows growth and shrinks the revenue base it depends on. If the Treasury shifts to shorter-term maturities to capture any rate relief, it increases rollover risk and exposure to future rate spikes. If it shifts to longer-term maturities, it locks in today's elevated rates for decades. Every door leads to another room with the same problem. This pattern is not new. It is one of the most thoroughly documented dynamics in sovereign finance. Carmen Reinhart and Kenneth Rogoff, in their study of 8 centuries of financial crises across 66 countries, documented the sequence explicitly. Countries borrow cheaply during periods of stability. Debt accumulates. The borrowing terms change. The cost of servicing rises. The government faces a choice between austerity, inflation, or default. The specifics vary by country and era. The structure does not. Let me take you to one more historical case, because it's the one most commonly cited as a reason not to worry, and it's the one that should worry you the most. In 1946, the United States carried a debt-to-GDP ratio of approximately 119%. It had just financed the most expensive military campaign in human history. The debt was real, the burden was enormous, and the United States resolved it successfully. Through a combination of robust economic growth, moderate inflation, and sustained financial repression, over roughly 2.5 decades, the debt-to-GDP ratio fell from 119% to about 32%. It is the most successful sovereign deleveraging in modern history. But consider the conditions that made it possible. The United States, in 1946, had the only intact industrial economy on the planet. Europe was rubble. Japan was rebuilding from ashes. American factories had no competition. The baby boom was just beginning, promising decades of labor force expansion and consumer demand. The Bretton Woods system had enshrined the dollar as the world's sole reserve currency, backed by gold. Immigration was supplementing the workforce. Energy was cheap and domestically abundant. Technological innovation was accelerating. The middle class was expanding. Productivity gains were broadly shared through strong unions and rising wages. Now consider the conditions of 2025. The United States has an aging population. Labor force growth is decelerating. Manufacturing has been offshored for decades. The dollar's reserve share is declining, not rising. Energy costs are volatile and subject to geopolitical disruption. Productivity growth has been sluggish for most of the past 20 years. Income inequality is at levels not seen since the 1920s. And the geopolitical environment is not one of uncontested American dominance, but of intensifying strategic competition. The post-World War II deleveraging worked because the United States had every structural tailwind imaginable at its back. The 2026 refinancing wall arrives with almost none of those tailwinds. The playbook from 1946 cannot be rerun in 2026 because the conditions that made it work no longer exist. This is an opinion. It's demographic data, trade statistics, and reserve allocation reports. It's documented. And this is the part that makes the arithmetic truly unforgiving. The United States needs to grow its way out of this debt burden, but the debt itself has become large enough to constrain growth. Interest payments divert hundreds of billions from productive public investment. Higher rates increase borrowing costs for businesses and consumers, suppressing private investment and consumption. The deficit, which must widen to accommodate the rising interest burden, competes with the private sector for available capital. This is the debt trap in its purest form. You need growth to reduce the debt ratio, but the debt itself suppresses the growth you need. Japan offers the most instructive modern parallel. In 1990, Japan's asset bubble burst. Over the following 3 decades, the Japanese government ran persistent deficits and accumulated debt that now exceeds 260% of GDP. The Bank of Japan held interest rates at or below zero for most of that period. Growth stagnated. Deflation took hold intermittently. An entire generation experienced no meaningful real wage growth. Japan avoided a dramatic crisis, but it paid the price through decades of quiet erosion. The standard of living didn't collapse. It diminished, slowly, persistently, in ways that don't make headlines but reshape the trajectory of millions of lives. The United States may not follow Japan's exact path, but the structural similarity, high debt, aging demographics, monetary policy increasingly constrained by fiscal reality, is closer than most public-facing analysis is willing to acknowledge. Now, I want to address a claim that frequently surfaces when these topics are discussed, because it serves as the primary intellectual defense against concern. Some economists argue that sovereign debt doesn't matter for a country that borrows in its own currency. The argument holds that because the United States can always create dollars to service its obligations, it can never technically default. This is true in a narrow, legalistic sense. The United States government will not bounce a check. It will not miss a coupon payment. But technical solvency and fiscal sustainability are not the same thing. A government that creates money to service its debts doesn't default on bondholders. It defaults on its citizens. The currency loses purchasing power. Prices rise. Real wages stagnate or fall. Savings erode. The standard of living for ordinary people declines, not through a dramatic rupture, but through a persistent grinding reduction in what their money can buy. This is the form of default that doesn't appear in credit rating reports, but appears in grocery receipts and rent increases and the quiet desperation of people who followed every rule and still can't keep pace. This is not a hypothetical. This is measurable. Between January 2020 and December 2024, cumulative consumer price inflation in the United States exceeded 20%. Real median wages, adjusted for that inflation, barely kept pace. For lower-income households whose spending is concentrated in food, housing, and energy, the categories with the highest inflation, real purchasing power declined. The default is already happening. It's just not called a default. Let me return to the timeline. By the end of 2026, if current trajectories hold, the United States will be spending more on interest payments than on any single program in the federal budget. More than national defense, more than Social Security, more than Medicare. The interest bill will be the single largest expenditure of the federal government. And unlike discretionary programs, it will be growing faster than any other category because interest costs are not subject to congressional appropriation. They are automatic. They are contractual. They are the one line item in the federal budget that is truly non-negotiable. And here's what distinguishes 2026 from previous debt scares. In 2011, when Standard & Poor's downgraded the U.S. credit rating for the first time in history, interest rates actually fell. Investors fled to Treasuries as a safe haven, paradoxically rewarding the downgraded borrower with cheaper credit. The downgrade was a political embarrassment with no financial consequence. In 2023, when Fitch downgraded the U.S. again, the market reaction was similarly muted. The pattern held. America's borrowing privilege seemed inexhaustible. But privileges that appear inexhaustible are the ones most vulnerable to exhaustion. Every empire that financed itself through monetary privilege, Rome with its progressive coin debasement over 3 centuries, Spain with its flood of colonial silver that triggered the price revolution, Britain with its sterling reserve status that unwound between 1945 and 1967, maintained that privilege until, quite suddenly, it didn't. The transition was never gradual from the perspective of those living through it. It was gradual in retrospect. It was sudden in experience. The question is not whether the United States will face a fiscal reckoning. The math has already answered that. The question is what form the reckoning takes. A slow Japanese-style erosion of economic vitality, stretched across decades, invisible in any single year, but devastating in aggregate. A sudden Greek-style crisis of market confidence, compressed into months, forcing emergency measures under duress. A managed British-style imperial retreat, cushioned by institutional competence, but irreversible in direction. Or something with no precise historical analog, shaped by forces that previous eras didn't contend with. Algorithmic bond trading, cryptocurrency alternatives to sovereign money, artificial intelligence transforming productivity, and a multipolar geopolitical order replacing the unipolar one. What is not in question is the direction. The trajectory of debt, interest costs, entitlement obligations, and demographic pressure points one way. Every year, the refinancing wall is not addressed. The eventual adjustment becomes more severe. Every year, the deficit widens to cover rising interest. The principal grows. Every year, the principal grows. The following year's interest expense rises. It is a feedback loop with no internal mechanism for self-correction. It requires external intervention, political will of a kind that no democracy has demonstrated in peacetime. Some analysts point to the possibility that a return to low interest rates would ease the pressure, and mathematically, they are partially correct. If rates fell back to 2020 levels, the interest burden would stabilize. But rates were at those levels because of extraordinary crisis conditions. A global pandemic, a near total shutdown of economic activity, a collapse in demand so severe that central banks around the world were forced to intervene at unprecedented scale. Wishing for a return to those rates is wishing for a return to the catastrophe that produced them. That is not a solution. It is a different disaster with a temporarily favorable side effect. Others argue that sustained economic growth will outpace the debt. Historically, this has occasionally been true, but the growth rates required to meaningfully reduce a debt-to-GDP ratio above 120% in an economy with slowing population growth and stagnant productivity are rates the United States has not sustained since the late 1990s. And even that era's growth was powered by a once-in-a-generation technology revolution and a peace dividend from the Cold War's end, neither of which can be replicated on command. This is the point where most public analysis stops. The problem is described. The options are cataloged. The conclusion is left deliberately vague, because clarity would require saying something uncomfortable. But history does not do vague. History resolves these situations, and it resolves them in ways that are predictable in structure, if not in precise timing. The cost will be borne by ordinary people. It always is, whether through inflation that erodes purchasing power, benefit cuts that diminish the safety net, tax increases that shrink disposable income, or reduced public investment that degrades the infrastructure, education, and opportunity that future generations depend on. The form varies by country and era. The distribution does not. Those with substantial financial assets, with access to inflation-resistant investments, with geographic and economic mobility, adjust their positions. Those without those advantages absorb the full cost. In Weimar Germany, the industrialists who held factories, land, and foreign currency emerged from the hyperinflation wealthier than before. The middle class, with its savings in mark-denominated government bonds and bank accounts, was destroyed in months. In the Latin American debt crises of the 1980s, the international banks that had issued reckless loans were backstopped by the IMF and the U.S. Treasury. The citizens of Argentina, Brazil, and Mexico experienced a lost decade of plummeting wages and surging poverty. In the Eurozone crisis, the institutional holders of Greek sovereign debt were partially protected through coordinated bailout mechanisms. The Greek pensioner who had worked for 40 years saw their monthly income cut by 40%. The pattern is consistent enough across centuries and continents to be called a structural law. When sovereign debt reaches unsustainable levels, the resolution invariably involves a transfer of REL wealth from the general public to the creditor class, mediated by the government's overriding need to maintain access to future borrowing. The state cannot afford to alienate its creditors, because it must return to the market tomorrow. So it protects the bondholder and adjusts its obligations to the citizen. This is not corruption. It is not a conspiracy. It is the structural logic of a system that depends on continuous access to debt markets for its basic operation. This is historical and educational analysis, not financial or investment advice. The purpose of this examination is to identify patterns, study mechanisms, and understand how systems behave under structural stress. Nothing presented here should be interpreted as a recommendation to buy, sell, or hold any financial instrument or asset. Let me return one last time to that windowless conference room at the Treasury Department. The analyst staring at the maturity schedule understands everything described in this analysis. The people in that room are among the most technically capable financial professionals in the world. They understand the maturity wall. They understand the interest rate dynamics. They understand the limited menu of options and the constraints that govern each one. And they understand something else that the public has not yet absorbed. There is no plan. There is no classified strategy document that resolves this. There is no quiet arrangement being negotiated behind closed doors that makes the math work. There is only management. Day by day, auction by auction, rolling the debt forward, adjusting the maturity mix at the margins, hoping that growth materializes, that rates moderate, that some convergence of favorable outcomes opens the fiscal space that pure arithmetic says does not exist. Hope is not a strategy. But when the mathematics leaves no good options, hope is what fills the void. The 2026 debt crisis is not a crisis in the way most people understand that word. There will likely be no single moment of rupture, no Lehman Brothers weekend, no emergency presidential address. That is precisely what makes it so dangerous and so difficult to mobilize against. It is a slow-motion narrowing of every option the government has. It makes every future recession harder to counter with stimulus, every future conflict harder to fund, every future investment in infrastructure, technology, or education harder to justify against the relentless growth of the interest line. It is the quiet foreclosure of possibility. And the most unsettling dimension is this. Everything I have described is based on the baseline scenario. The Congressional Budget Office projections underlying these numbers assume no recession between now and 2034, no major military conflict requiring emergency appropriations, no new pandemic, no financial crisis. They assume trendline growth, stable employment, and no extraordinary shocks to the system. In other words, the math is this unforgiving under-optimistic assumptions. Any disruption, and history guarantees there will be disruptions, makes every number worse. The bonds have already been issued. The maturity dates are already fixed. The rates are already higher. The interest compounds whether anyone is paying attention or not. The pattern is already in motion. It was set in motion years ago by decisions that were rational at the time under conditions that no longer exist, by institutions that cannot reverse what they've done without creating the very crisis they're trying to avoid. The question was never whether the bill would come due. It was always who would pay it, and whether they would understand what was happening before the options had already narrowed to one. If this kind of structural analysis is something you find valuable, the kind that traces the mechanics underneath the headlines, that studies how systems actually fail rather than how commentators say they might, then this channel was built for that purpose. Consider subscribing. because the next pattern is already forming, and most people won't recognize it until the spreadsheet is already someone else's problem.